Well, Cameron, welcome to Equity Mates.
Thank you for having me today.
But before we jump into unpacking everything that's going on in private equity markets at the moment, it'd be great if you can just help us understand a bit about your journey in private equity.
Yeah, so I joined Pacific Equity Partners in 2002, really out of Bain & Company, which is a strategy consulting, which is an important part of the story of PEP because we actually started within the Bain & Company office. We were set up effectively by Bain Capital in 1998, and the whole idea behind Bain Capital and PEP was to put capital behind strategy consulting. So rather than just consulting for time and materials, it was about actually buying the companies and implementing that strategy, and seeing that value uplift that came from that implementation, as a capital participant rather than a consultant.
Yeah, it's pretty interesting.
Yeah. 1998 turned out to be a great time to start a private equity firm because the past 2 decades have been pretty incredible.
Yeah.
Private markets have outperformed public markets, and there's been some pretty amazing results. Tell us a bit about that story and some of the numbers behind the private markets growth.
Yeah, so I think it all comes down to outperformance of the public market. So if you look at on an average basis, private equity outperforms public markets on average by about 5% per annum. So that's on an average. If you actually start to really look at the best managers in the world, that outperformance goes to 10 or 15%. So
Wow.
if you're seeing public markets perform in that sort of 8 to 10% range over the long term, private equity is more in the 20% plus at the top end. The best managers. So that outperformance is real, and it has, as you've said, been sustained over 2 decades.
So like rough numbers, you're doubling your money every 3 to 4 years rather than like 7 to 8 years.
That's correct. That's exactly right.
That
private equity,
that compounds.
Yeah. Yes, it really does.
We need a podcast, private equity, mate.
Yeah, that's right.
Yeah. All right, we'll take that offline. Maybe you can co-host with us.
Yeah.
So Cameron, I guess the question that follows then is, what do you actually attribute this outperformance to?
Yeah, I think it's really clear. It's actually a better governance model. So if you can imagine what happens, and I've sat on some public company boards as well, it becomes a real division between shareholders, board and management. And you have a lot of discussions at a board level that aren't really about creating value. They're actually about checking boxes and remuneration committees and all these types of things. And obviously the shareholders are one step removed from the management as well. That doesn't exist in private equity. We have a very, very direct line with the management of our companies we own, and there's a really strong alignment with our management team. So it's about setting strategy, giving management access to capital, and letting them go and execute that strategy. And it's a very clear model, and that is very clearly what drives that outperformance. I think there's another aspect of the public markets that's important to talk about. One of them is this quarterly or 6 monthly reporting, and also that the companies are there forever. So they sort of actually are stuck between this world of short-termism and forever, where with a private equity company, we tend to have a time frame of 4 or 5 years, and so it means that you take a medium-term view, like a project view. So you're not really worried about the next 6 months, but you're also realise that at some point you will sell the business. So you have a project plan to transform a business over a period of time. So that governance model and that time frame that you can take, a bit of a longer term view, but not a forever view, really is what drives that considerable outperformance in the private markets.
Interesting.
I can just already feel in myself get super excited about private
equity
because both of those things make so much sense.
Yeah.
Like especially the governance structure. I never really thought of that, but now I'm just thinking about the shortcomings of the public markets governance structure.
Yeah. And look, I think the public markets make a lot of sense for the big banks and big regulated businesses and the like, but for a lot of your sort of medium-sized companies that are on the ASX, or even the smaller companies on the ASX, they probably shouldn't really be there. They're not really set up in a way that's conducive to fast, good decision making.
Yeah. So, despite this outperformance, private markets have been a little bit more inaccessible and just, haven't been front of mind for a lot of investors for the past couple of decades. And that's led to an underexposure, both in individual investors and in a lot of institutions. Talk to us about that underexposure. Just how underexposed is the average investor?
Yeah, so I think, look, the large global institutions are actually sort of have about 40 to 50% of their portfolio in the private markets. Is actually substantial.
Yeah, wow.
When you then come all the way down to individuals, you're less than 5%, sometimes zero. Why is that? I think there's obviously an awareness element of that, but also, there's you are investing in managers, so there's a lack of sort of transparency in terms of who are the good managers. So there's a sort of a manager selection challenge that an individual has. But also, when you're going into these private equity funds, traditionally your money's been locked up for 10 years. And that's a very difficult thing for an individual to commit to, because life circumstances change and all those sorts of things. You do want access to liquidity, so it's really those combinations that have really caused particularly the individuals to be massively under allocated to the private markets compared to the public market, or compared to institutional shareholders. And I think there's some really interesting stats around the place. It's only about 2% of companies are public. 98% of companies are actually private, which makes sense when you think about, the way that business and industry actually works. And so, an individual that's only got public market exposure is actually exposed to a very small subset of the companies. And so you can see from an institutional investor perspective, looking for diversity, it makes a lot of sense for them to have a big exposure in private markets.
Awareness is definitely increasing, though. I think we do every year a bit of a check-in on how many companies are IPOing, and it's just getting less and less each year because more of them are staying in private for longer and then just getting scooped up by all the big private equity firms. So us as retail investors can't get them.
It does grind our gears when we see companies get taken off the boards, like good companies get taken off the board. I'm like, damn, well, there goes that opportunity.
And you're seeing some real concentration, particularly in the Australian public markets. You've got the big banks and resource companies dominating the indexes. So you've got to sort of really, you've just had a bunch of building materials, in Boral maybe going, or CSR going. So the sort of universe, available universe in the public markets is decreasing.
And now super funds are doing it. Like Sydney Airport gets taken off the board. Anyway, that's a completely separate
I think it goes back to this. It goes back to this governance issue that we were talking about.
Well, let's turn to Pacific Equity Partners. It's Australasia's largest private equity firm. Give us a bit of an overview of the track record over the last 20 years.
Yeah, so look, we've, as I spoke about earlier, we got going in 1998, and if you just look at our returns, over that period of time, it sits at about a gross IRR of about 41%.
Yeah, I saw that number. And I was
it's a net return of mid-20s. So we do. It's not. We don't work for free, but we do and are very conscious that delivering those sorts of returns over a long period of time to our investors has meant that we've got a very loyal following, and it's not been without ups and downs over periods of time. So we're not infallible. But it's a pretty consistent track record that we've got, and we also understand that investors love making money, but they also hate losing money. So we do take a pretty conservative approach to the way that we invest, and we're generally doing late stage private equity. So these are big established businesses. It's not startups or growth capital. It's late stage private equity that we focus on.
Well, we'd love to get an understanding of your process, Cameron, and really get some insight into how you guys go in and create value for all the shareholders. We've asked you to come with a bit of a case study, and you've shared Intellihub.
Intellihub,
yeah.
yes.
So let's start from the top. What is Intellihub? When did you first identify it as a company to target?
Yeah, so Intellihub's Australia's largest smart metering business. So this is, its role in the energy transition is going into, homes around Australia. It's already in about 2 million homes, putting a box on the wall in your meter box that communicates back to the cloud and actually means you don't have to have meter readers going around the street. So our clients at Intellihub are the big energy retailers, so think Origin, AGL and the like, and we're putting those boxes on the wall and then feeding the data back to them for billing. So that's what Intellihub does at its core. How we identified this business sort of back in 2016-17. We knew that some new legislation was coming through in the market to make it the retailer's responsibility to look after metering. Prior to some legislation that went through in 2017, that was actually the responsibility of the network companies, so the distributors. So think of Ausgrid and Endeavour and the like, and that legislation changed it to the retailer's responsibility. But we knew that the big retailers couldn't actually or wouldn't want to look after that responsibility. They would want to outsource it because customers churn from AGL to Origin, and AGL doesn't want Origin looking after their meters. So we were very fortunate. We knew that Origin were thinking about divesting their smart metering business. We had good connectivity into the Origin senior management and board. And we started to knock on their door well before we ended up acquiring, probably a year campaign of asking them whether they were ready to sell. We got some very strong feedback from them that they didn't want to sell to a purely financial buyer. They wanted somebody with expertise. So we actually teamed up with the world's largest smart metering manufacturer called Landis & Gyr. And it was actually a co-bid that we went and put a co-proposal that we went and put to Origin. So we were the only financial sponsor, if you like, in that process. So they ran a very limited party process with a couple of other trade participants, and we were fortunate enough to be successful in that process.
Yeah.
Oh,
Wow. Okay. And so we were going to ask about the process, and you mentioned there you had some good connections in with senior management. That always helps.
Yeah.
But it was still a bidding process.
Yeah.
You still had to pitch
I think the reality particularly when we're buying big businesses, and a lot of what we do at PEP are corporate carve-outs. The big corporates, they do want to make sure that they're not doing sweetheart deals with people. They've had a little bit of competitive tension in their processes to divest their assets, but it's also about having a track record of successfully carving businesses out. And it is very important to those big corporates that they are selling to a party who's going to do the right thing by their customers or their people and all that type of thing. So we've got a 26-year track record where 50% of the deals that we've done are corporate carve-outs. So, we've walked into that type of situation quite often where, there's some trepidation dealing with, a purely financial buyer of assets and them looking a bit silly or all those types of things. So, I think we've just developed, a way to engage with them. Obviously, we're ex-consultants in Bain & Company, so we sort of understand how big corporates work and how to engage with them. So I think that puts us into a bit of a unique place where they don't run a really large auction; they'll run a limited party type process.
So you pick up the business in 2017?
It was actually 2018 by the time we...
So it took some time.
It took some time, yeah.
What's been the story from there? You've now got this streamlined governance structure.
Yeah.
What have you done?
When we picked it up, it was actually a loss-making business. The real attraction for us, it came with a 20-year contract to roll out another 1 million metres with Origin Energy. So it was really the contract that had the value within it. And we had to work very hard and put a lot of money into technology and software development to really build the business into a really high quality standalone business that could provide services to other people other than just Origin. So that was the start of the journey. So it took us 2 or 3 years to really get that humming. We won a lot more contracts. We also went over to New Zealand and did a corporate carve-out of Mercury Energy's smart metering business called Metric, put that together with the one that we'd bought with Origin. So that was a big, heavy lifting establishment of a business, all the processes that go around that, and that was that 3-year journey. So I can continue to talk about Intellihub for a long time. So maybe we can move on to the next phase.
Yeah. Well, what was the next? Phase?
So the next phase. so look, the next phase was we realised that there was just a very long runway with Intellihub. Every Australian home needs to be have a smart meter in it by the end of this decade. That means there's another 6 million homes to visit.
Is that a law?
That it is it is getting passed right now.
Okay.
It's already been sort of it's getting legislated, but it's already been sort of passed as it's going to happen. So by 2030, everybody has to have a smart meter. So it's a massive, a massive rollout that's coming. It's a little bit like the NBN, effectively, right? We went searching for a very deep-pocketed partner. So. We ran a limited party process to select.
Aren't you the deep-pocketed partner?
Well, we found another one that was even deeper because there's an awful lot of capital. So, we were very fortunate to select Brookfield as our partner in Intellihub. They're a $1 trillion manager. They're very deep-pocketed, and they've got great expertise and connectivity. We recapitalised the business at $3.3 billion. We sold 50% as a partnership to Brookfield, and then we took the other 50% pool of capital and put the other half of Intellihub into that vehicle. In our industry, it's called a single asset continuation vehicle. And really the idea behind that was to line up with the timeframes that Brookfield, so we had equal ownership and we had equal timeframes. So it was a very logical thing to put the business together that way, and we continue to own half of it. I continue to be the chairman of the company, and we continue to grow it, and it's just going from strength to strength, Intellihub. So hopefully we'll be bringing it back to market in a number of years' time, and even a larger format than we went in.
I was going to ask about the timing of it there, because you sort of mentioned a lot of private equity deals. You're thinking medium term, maybe 5 to 7 years.
Yeah.
But the law was out till 2030 that you're mentioning, and then you mentioned the 20-year contract with Origin. So
right.
How do you think about those different durations? And I guess if you buy a great asset, you don't want to sell.
That's right, and that's really where this innovation of single asset continuation vehicles has come from. We do tend to want to crystallise for our investors their returns after that sort of 3, 4, 5 year period. So these really are vehicles to enable you to provide a liquidity opportunity for existing investors if they so choose to take them. But then double down and keep going again on your trophy, star assets that you have, because it's hard to find good assets. So, when you're on a winner and you can see another horizon of growth, this is a great way to double down and continue to go again.
Over the 20 years that you've been in business, pumping out gross 40% returns, the process that you just went through sounds incredibly intense and a lot of work. How many deals are you running in parallel, or how many deals are you actually, engaging in over that period of time?
Yeah, well, we look at about 100 deals a year, and that sounds like a lot, and it is a lot. But we filter out probably 50 or 60 of those pretty quickly. They just sort of don't fit our criteria. We looking at, market leaders, in pretty stable industries. So, once you filter out a lot, you probably end up with maybe 40 that you do a little bit of work on.
Right.
And then, you might really get engaged on 20 of those, and you're doing sort of full due diligence on, a dozen a year, and you may be, executing on 3 or 4 a year type of thing. So it's a big filtering process, and it is very time intensive, and you do need a big team to be able to continue to look at those types of opportunities.
Of that 100, is a lot of it you going out with like we have identified this as the opportunity, like you did with Intellihub,
Yeah.
or like what's the difference between inbound and outbound?
Oh, look, it's a little bit more messy than that, I think, is the reality. And we've been in the market for 26 years, so obviously we're a very well known player in the capital markets. We do have a lot of people walking through our door, putting ideas in front of us all the time, and obviously we're forming up our ideas about what to look for. So, in the Intellihub example, we've actually done a number of investments in the energy industry over that 26 years. So, we were sort of familiar with the businesses that were moving. And so it's a little bit of a combination of both. Yeah.
So just hearing you talk about those single asset continuation vehicles, all it makes me think is they are a perfect candidate to return to the listed markets and a way to give people like us access to some of these assets.
Yeah, I think, look, it's a great question, and I think traditionally there's been three ways for private equity to monetize their investments, if you like. One is to sell it to a big trade, once you've got an asset. One is to sell to a big trade buyer. Another one is to IPO and bring it into the public markets, or you could sell it to another financial sponsor like ourselves. So these single asset continuation funds are like a fourth exit path, where you actually create your own vehicle to move an asset from a commingled fund into a single asset fund. So there's no doubt that it does give yet another path for private equity not to bring companies to the public markets. But I think we're still very open to IPOing our businesses if the asset sort of suits that environment and the market's positive and the like, or receptive to our assets. So it's important when we own an asset that we do have multiple pathways to liquidity for our investors.
Well, let's turn to the Gateway product. Before we kind of jump into it, there's a bit of jargon there. You've said single asset continuation funds.
Yes.
Not a common term that we get in equity markets.
No.
So can you help the audience understand what that means?
Yeah, so these are relatively new even into the private equity market. They started about 10 years ago in the US, like a lot of innovation in the financial markets happen. And they were set up in a way for the best private equity firms to find their best assets and to hold them longer. So that's effectively the background from them. So, I think the best way, just to simplify it all, these are, the real star assets, out of the private equity world that, people want to hold and invest in for longer.
Correct me if I'm wrong, but like the traditional private equity fund is a commingled fund. So you might raise, X billion dollars and you might buy, I don't know, 10
companies. That's right.
Companies. And then, so that's a commingled vehicle. And then you'll at some point sell them or IPO them, return money to investors. And then this is the single asset. It's just single.
That's right. And I think they end up being the star assets because to get these vehicles up and running, the incoming investors demand that you, the private equity sponsor, need to roll all your economics into the new vehicle. And that really means that you tend to just pick your star assets to do that because you really believe. So it's a doubling down opportunity, and that's why they're such an attractive asset pool. So we've done two of these. We did the very first one in Australia, which was Intellihub. We've done a second one over a business called Up Education. So we're really the innovator in the Australian market around this space, and having done a few ourselves, we think it's a great thematic to be investing behind.
Well, the Gateway product, I guess, tries to open up that thematic to more investors.
Yeah.
So tell us about this product.
Yeah. So this really initiative from PEP started about 3 years ago. We had a lot of our ex-CEOs and management team, or the lawyers and bankers and accountants that we work with all the time, asking us whether they could invest alongside of us in our funds. The problem is with our traditional institutional funds is they do have 10-year lockups and very high minimums. So we started to conceptualise.
Hold on, what's the standard minimum for a standard
Well,
fund?
it's a $10 million minimum typically, so it's a little,
yeah.
I mean, look, we do for our family and friends lower that to sort of $1 million, but it's still.
Okay. So we should go for a beer.
That's right. But look, it's still a pretty inaccessible thing. 'Cause for you to have a truly diversified portfolio of private equity funds investment, then you don't want to just have PEP. You want to have a range, and then all of a sudden to build that program, you've got to hit $1 million a lot of times.
Yeah,
so
you've got to be an institution.
That's why it is pretty inaccessible to individuals. So it really was born out of there, and we had a existing portfolio of investments ourselves on our own personal account. So we sort of pulled those together and started to invite our family and friends to come and invest alongside of us. But we were very acutely aware of the need for liquidity. So we structured it into an Australian managed investment trust, just like a normal managed fund with a monthly unit price where people could come in and out on a monthly basis. The primary focus is into these all-star, creating an all-star portfolio of single assets, but we also complement that with a little bit of listed private equity. So these are, the funds, the big alternative asset managers in the US, like a KKR or an Ares and the like. And so within the Gateway fund itself, there is some listed private equity as well, about 15 to 20%. And that enables us to have the liquidity, to provide monthly liquidity if an individual so chooses. Obviously, we're suggesting the right time frame is a 3 to 5 year hold, but people's life circumstances do change. So if they do want their money back, we'll return their money back. So that's the Gateway Fund. It's been going for about 3 years or so, and we're pretty excited about it as a new vehicle for individuals to be able to get access to really an all-star program of global private equity.
We should be clear, it's not just Pacific Equity's single continuation vehicle funds. Single asset continuation funds. But it's these funds from around the world.
So look, we're in a very fortunate place that we've been in the private equity industry for 26 years. It's over a quarter of a century, and we do know who the best private equity managers are in the world. We're one of them, and it's sort of a club. So we're very much in that club and able to know who the best of the best are. So the idea behind Gateway is you should have a diversified portfolio. You definitely should have some PEP, but you should have some of these other names that are the best around the world. So the idea is that we're creating a diversified portfolio of all-star type assets for individual Australian investors. That's the right way to think about it. And so it ends up being about 50% North America, about 20-30% Western Europe, and the balance into mainly into PEP, Australia and New Zealand type assets. So good diversified portfolio for people across a different range of different managers, a range of different sectors, and so we think that's important.
Well, it's good to see it slowly becoming more and more accessible to everyday investors.
Yep.
One day we'll get there, Ren.
Yeah.
Now, if you're interested in the PEP Gateway, head to the website. It's pepgateway.com.au. We'll put it in the show notes. There you can find all the information about the strategy, how to invest, and also some contact information if you'd like to give Cameron a direct call.
Look forward to it.
Now, Cameron, that does bring us to the end today. We really appreciate your time. And as I said, it is great to see that slowly this is becoming an industry or a sector that's becoming more accessible.
Thank you. Look, we're really passionate about the private equity world. It's certainly I've had a lot of joy and excitement sort of working in the industry for over 20 years, and I think it's really just starting to hit its straps after 20 years. It's an industry that's professionalised. Our communications with our investors is really important. We want to make sure it's very transparent and people know exactly what we're up to. So, the private equity is becoming less relevant. Yeah, we look forward to hopefully you joining us as an investor.
That'll be the day.
If 41% gross returns isn't hitting your straps,
Yeah.
I can't wait
true.
to see what hitting your straps looks like.
Yeah. Thank you.
Thanks, Cameron.